Welcome everybody to P Confidential. I'm here with Jonathan Cooper, and the topic today is about private equity investment in emerging markets on the smaller side, on the mid-cap side, and the use of derivative instruments such as hybrid instruments or debt instruments rather than pure equity instruments. And Jonathan was a manager in Growfin, which is an emerging markets investor, which exactly fits that profile. So, Jonathan, maybe just say a few words about yourself and what your role at Growfin was to get us started.
Sure. Thanks, Kevin, and thanks for inviting me back on to PE Confidential. It's always nice to come and participate in the show. So my background, I worked for Growfin from 2011 to 2013, about 2.5 years. And I was managing their fund based in Oman, but I also had regional responsibility, particularly doing trainings and overseeing investments throughout a wider region for the fund. And Growfin is a South African-based fund management group that specializes in debt or debt-structured investments, but taking equity-type risk. Throughout sub-Saharan Africa and Middle East and North Africa. And I believe they have funds now in about 15 countries and managing close to $500 million in capital. And most of their investments are in this sub $1 million range, actually sub $500,000 range, and a lot of work in the agribusiness sector. So I think quite interesting given some of the topics that we wanted to discuss. Also, prior to joining Growfin, I worked for SEAF, which is also a major impact investment company in Central Europe. They're based out of Washington. They do a lot of work in Central Europe and Asia as well. So I spent most of my career in this, this is called impact investment world, doing these kind of 1 million and lower growth investments.
Okay, well, that's an interesting experience, particularly and very topical as far as Africa goes. So let's get on to the specific subject, which I wanted to talk to you today in our chat, which is using non-pure equity investments. So perhaps we could kick off. I mean, what is the main, let's say, overall rationale that you had at Growfin, or in your view for a kind of low mid-cap fund manager and impact manager in Africa or thereabouts to use a more of a debt type instrument rather than equity? What's the kind of strategic rationale, if you like?
It's primarily the self-liquidating nature of a debt investment, debt structure. So if you're doing, let's say, small cap equity investments in the United States and Western Europe, you have an exit market that's quite active. Unfortunately in Africa, and it has gotten better over the last 5 or 10 years, but still it's difficult to exit, especially small investments. There's not a very active M&A market or acquisition market. And consequently, doing straight equity investments is a challenge. And that is why Growfin was, for one part of the reason, choosing debt structures, because again, they're self-liquidating. In other words, you get your money back when you get repaid the debt over a period of time. The second reason was legal. It was difficult in some countries. They didn't have great legal structuring for equity investments. And consequently, putting our investment in as debt gave us more rights because the legal framework was set up for banks, and consequently providing capital through a loan structure gave us some protection under that legal construct that they had already put in place. So those were the two main reasons. One would be the ability to exit, get our money back, and debt being a self-liquidating instrument, and the other being legal protections, which are more readily afforded to debt providers as opposed to equity providers in some of those sub-Saharan Africa markets.
Okay, so interesting. So exit and legal protection, so being better protected as a creditor than as a, say, minority investor. What were the specific countries where there was relatively weak legal protections? Was there any difference among the countries, with some countries having adequate and some having particularly weak ones where you really had to go with the debt instruments?
Well, that's a good question, because we did cover, as I mentioned, about 15 different countries, and I was not familiar with all of them. But generally in the sub-Saharan Africa markets, places like Kenya, Rwanda, Ghana, where we had, Guyana, where we had some operations, Botswana, there we would find it a little bit less equity friendly. And some of these markets did have reasonable laws on the books, but they hadn't had much practice in courts. And it's always a challenge to be the first one if you need to go to court and try to establish your rights under these laws. So we found Sub-Saharan Africa was more challenging. South Africa was a bit clear. Oman and some of the Middle East and Northern Africa markets, Egypt, were also a bit clear, but some of those Sub-Saharan Africa markets were a bit more of a challenge.
Okay, well, that's interesting. Okay, well, look, thanks for the introduction and the overview. So let's get on to the second question that I want to cover is a bit more detail on the deal structuring. Obviously, you're a consummate fund manager. You've done many investments. So how does the deal structure take place? Is it simply a question that you lend the company money as a senior lender, subordinated? Does it have any bells and whistles with it in your experience, like some equity components? So what kind of deal structuring considerations were made in terms, and how were the deals generally structured? What was the instrument? What were the other rights maybe attached with it?
We use a bunch of different structures depending on the situation. So it was, let's say, flexible. We would normally go in as debt, as I mentioned, but we were taking equity type risks. So we would charge an interest rate that reflected the risk we were taking. So it wasn't like we were taking the interest rate of a bank that's fully collateralized, because in most cases we weren't fully collateralized. We were basically doing, as I mentioned, equity type investment, but using a debt type structure. We would take collateral on what we could, company assets and whatnot. We may take a share pledge in some cases as collateral against our loan. So if the loan wasn't repaid, we could take over the company by activating the share pledge. We would sometimes get personal guarantees by the founders. That can be a bit problematic because, of course, if you're taking equity type risk, founders don't generally guarantee equity investments. So that wasn't really our strategy. We recognized that we were taking equity type risk. We tried to structure ourselves to protect us, but not to be overbearing to the founders of the company. And we would register our collateral where we could with the courts. And we would always use local legal representation, the folks who knew the local markets well and the laws, and we would get their input on the best way to structure it to give ourselves a fair amount of protection. So again, in case the loans weren't repaid, we would be able to have some recourse against company assets. But it was definitely quite variable based upon the situation. If a company already had loans in place, for example, from the bank, we would simply review those and see where we would fit into the capital structure and the lending structure. We found oftentimes banks would take collateral against a specific asset, like a building of the company, or in some cases, they would only take assets as collateral that were personal assets of the owners. And we would then take collateral over other assets that remained available. And again, the idea here, since we were taking equity type risk, was not necessarily to have full collateralization of our loan. In most cases, we didn't. We were looking at the cash flows of the company as protection, but rather that we would have a leverage point. So in case the loans became past due, we had gotten to a situation where we needed to submit some claims. We did have collateral on the cars, on the production equipment. And although that didn't give us full, again, collateral in terms of the value of those assets, it gave us a lot of leverage over the company in case we had to go into negotiation at some point with our client.
And did you have any mechanisms on the loan product, such as maybe had a conversion feature that could be converted into equity, or was there any kind of other rights attached to it, like veto rights over company decisions, like you have on equity, or some other kind of the bells and whistles you would see in private equity?
There's a couple of things that we did. If we saw the company had a real potential to get a proper exit at some point in the future, we may ask for a convertibility feature. And this would be something like a technology company. We didn't do many of those, but if we did, we would try to get ability to transfer or convert into equity in case they got a big exit at some point. If it was a company that was more, we invested in a lot of schools, agribusinesses that were more, let's say, mom and pop businesses or solid businesses for the community, but there was never really any intent on the owner's side to try to seek a big exit, then we wouldn't push for that. Another structure issue that we use, and we learned this the hard way, and we did the same thing at SEAF, interestingly enough. And there's a lot of stories with both of the organizations that are basically were pioneers in doing this kind of emerging markets impact investing. And that was to monitor the money during disbursement. So with Growfin, we would basically approve a loan to a company, let's say $300,000 for a list of equipment. We wouldn't simply transfer the money to the company's account because it often had a way of going to other expenses that were not in the original plan. Rather, we would have them send us the invoices for the equipment they were buying, and then we would directly transfer the money to the vendor and buy it on behalf of the company. And there was a little bit of a legal procedure depending upon the market to make sure that the assets were recorded with the company and that our contribution was recorded as a debt. But basically, we use that mechanism to control disbursement of the funds. At SEAF, we did it a bit differently. At SEAF, we required the company to open a bank account it was a company bank account, but required our signature and theirs to disperse funds. And then we would put our investment in that account, and that account was simply structured or set up to disperse the investment. Once the investment was dispersed, again, based upon our signature of releasing funds, once it was all fully dispersed and the account was depleted, we would close the account. So those were the two methods that I saw quite often used to disperse money, and were very. It was very important to do it that way, and important for two reasons. First one, of course, is to protect the capital, make sure it goes where it's supposed to go. But the second one was also to establish ourselves as a partner in the company and let them know that hey, we are. It is important to us that we follow the plan. We're going to meet every week or every 2 weeks, whatever it might be, in the first, let's say, 100 days of the investment to monitor the investment. And this is the mechanism we're going to use to actually flex our muscles, so to speak, as being a partner in the company. And I think that's important with these smaller founder-based companies that aren't used to having a partner.
Okay, let's have just one last question before we move on to talk about managing the portfolio. So once you've done your deal, how much did you interact with, say, banks if the company had some bank debt? As when you were negotiating the deal or structuring the deal, did you have any contact with the banks, or did you engage with them in some form of dialogue in order to make sure that everybody was comfortable with what was going on with the company? And were the founders okay with that?
Yes, we would require that. To discuss with the banks. If the company was in good standing with the bank and was doing well, it was usually a fairly brief conversation. We would confirm the loans payments are in good standing and the terms of the loans. What we found oftentimes, and this is not unusual with growth companies, is that they were in trouble with the banks. Now, the question would be why. If it was because they were growing very rapidly and ran out of cash, that's something we were interested in discussing. If it was because their business plan was failing, then obviously we don't want to be the lender of last resort, so to speak. In those situations where the company was in trouble with the bank, but we still saw a good investment opportunity, then we would interact with the bank more closely. Sometimes we would ask the bank to restructure the loans, either the repayment terms or the collateral terms. And, initially, the banks may not be so keen on that, but when they realize that we were going to put fresh capital in the company and give them a better chance of getting their loans repaid, it was usually quite a good dialogue with them. One thing I would recommend, if you do go into that kind of a discussion with a bank, so the company already has a lender in place, you need to do some restructuring on that, make sure you get all of that agreed to and signed off by the bank before you invest. My experience with banks is sometimes they're very good partners and very honorable, and sometimes they'll say whatever it takes to get the next guy in with some capital, and may not be quite as willing to cooperate once the next guy has put his money in the company. So again, if there's any restructuring of not only banks but also other vendor credits, make sure you get that in writing and done before you make your investment.
Okay, fascinating. All right, well, that's great. I think we've had a good coverage of the deal structuring. So now let's turn to, you've made the investment and now you have a claim on the company through your financial instrument. How do you set about managing your portfolio, say, compared to an equity investor? Obviously, an equity investor's profile is he would have board seats, he would have tag and drag along rights on the other block of equity, veto rights perhaps on decisions to look at some of the key things, maybe a put option. So how how would you set about managing your investment, with this kind of an instrument? Would you get a seat on the board? Is the level of engagement in the way, is it different, or is it the same as if it was an equity investment? How would it play out in general?
In general, a lot of the companies we were working with were smaller, as you mentioned, and we didn't treat them as formally as traditional equity investment in terms of having board representation, for example. If it was a big investment, like $1 million deal, reaching the upper level of our investment level, then we would potentially look at that. Or again, if it was a company that we thought had really quite significant potential with potential for an exit, more of an equity type profile, then we may look for a board representation. But generally, we didn't go for that. We would protect ourselves again through having, since we're putting our money in as debt, we would get repaid based upon the repayment schedule. So things like a drag along and a tag along were really not that important to us. What we would do is get a change of control clause. So in case the company changed control, i.e. They got bought out or a bigger partner came in, then we would have the option perhaps to demand repayment of our loan prior to that action taking place. But that was one of the nice things about the debt structure. We didn't have to worry about a lot of the more complex structures that came with equity.
What about the engagement with the founder?
Yeah.
I mean, obviously, apart from the structuring, what about spending time with the founder, helping him or her develop their business, which you would maybe as a board member or spending more time above and beyond that? I mean, how did the dialogue, the engagement with the founder, bringing your know-how to bear to help them grow their company, how did it differ, with this kind of an instrument as, say, a straight equity, or was it the same, or were they different, or was it some more of a background role? How did it change?
Yeah, it was actually quite similar. And I had done mostly equity investments with CEF, and then we're doing the debt investments with Growfin. And they had a similar approach in terms of being very actively engaged with the companies, which I think is quite important for these smaller businesses because they're usually founder managed, and they're usually having some gaps in the management team, whether it's in marketing or financial or sales, that we were able to support them with. So we tried to be very involved. Now, what becomes complicated is how do you actually measure and manage that? So every fund management group talks about the level of engagement they have and the value add they're giving to their portfolio companies. And at Growfin, we really spent a lot of time trying to figure out how best we can help the companies and how we can measure it. And we came up with a concept called business development engagements. And I would sit down with my team on a quarterly basis, and every one of our portfolio companies had a relationship manager. And we would basically identify, what's a gap in the company's management or company's operations that we can help them with. For example, one gap might be this company needs a salesperson. And I'd establish that as a goal for this quarter. And my guys' relationship manager's role in that situation may be to assist them in finding a new sales manager, or perhaps it was getting training in for their marketing people, or maybe it's setting up an accounting or financial reporting system. And these are some of the common ones that these companies you'll see repeated, these small companies need again and again. So we got pretty good at some of those types of engagements, and having the system in place, myself as a fund manager, I could really measure and manage the performance of my management team. Are they performing these engagements, and are they being successful with them? And I think that was quite a valuable system to put in place, not only for us, but also for our portfolio companies. They started to see more substantial value add at that point.
So I think what you're saying is that in fact, the fact you structured your investment as a debt was kind of lost in the wash once you sort of got stuck in with the entrepreneur, as if you were a shareholder partner, you helped them out. And that was kind of just lost in the wash. And it wasn't like the founder would say, well, you're not an equity partner. I want you to sort of, take a step back, and I'm going to take it from here. So what you're saying, that wasn't the case at all in these kinds of investments you're making.
That's correct. So we definitely were not a bank. The debt structuring were the reasons I mentioned in terms of being self-liquidating and the legal protection. But beyond that, we acted very much like an equity provider in the company.
Okay. And did you? I mean, if that was the case, did you also have board seats, although you were a debt provider, when it made sense to have a seat on the board? Could you also, as part of your agreement, take a seat on the board of directors, even though it wasn't equity?
Yeah, not too often. Again, if it was a big investment, but at least by our standards, we would, to get some extra protection. But we found two things. One, again, a lot of these are small family-based companies, and just the complexity of being on the board wasn't really worth it. We were able to get exert control through other mechanisms. And they were often also not very comfortable if it was a small family business having us on the board. In some cases, there were some legal consequences of being on the board that we weren't comfortable with. So yeah, we generally weren't, other than in special circumstances. And I think also one thing worth mentioning is with a smaller fund, you have a small management fee. Because management fee is generally based upon capitalization of the fund. And that means your resources are going to be limited. If you're managing a $15 million or $20 million fund for SMEs, you just don't have the resources to put in place that you can have, board seats with these companies and spend tremendous amounts of time with them. So we had to adopt more of a streamlined model, let's say, that allowed us to participate with the companies and add value, but also allowed us to reasonably manage a large portfolio of companies.
Were you ever able to charge any fees to the company for services over and above, let's say, normal supervision? Because sometimes if a fund manager spends a lot of time, or maybe gets one of their people, to go there and really help out, that's over and above what we could consider a kind of normal. Were you able to either charge the company's fees, or was it a question of trying to mobilize some technical assistance funds that might be out there in the market from DFIs and others that you could sort of bring to bear? How did that sort of play out, the economics of managing the portfolio?
Yeah, we didn't do that very often. I could see that happening, though, certainly in specific circumstances where you're adding specific value. For example, if you help a company to make a sale, and you're being compensated like a sales commission, as a typical sales agent would be. And that can be useful if you're in multiple countries. You may have a company that you're invested in Botswana. You also have an office in Kenya, and you're able to make a connection between a supplier and a customer and make a sale. I could also see that taking place if, for example, you help the company to raise capital, fresh capital, either from a bank or an equity partner, or if you help them to negotiate a sale. That would be quite reasonable to do. But in the normal course of our business, providing that value add that I had mentioned, whether it's financial management, accounting setup, training of staff, and things like that, that was usually just part and parcel of the services we provided as a partner in the company. Okay, great. And one question about the team. So the various teams you manage, the investment team's skill set between an investment team that does mostly equity deals and an investment team that's kind of focusing more on debt type structures. Is there any difference in the skill set among the team, say at the investment officer level? Is it more credit than valuation? What are some of the nuances and the differences in the skill set the team needs to have? Yeah, that's a great question. And with Growfin and the office in Oman, most of my team were coming from the banking side. And that's a great experience to have when we were putting the deal together and doing the structuring and doing some of the analysis of the company. Unfortunately, when it came time to do the portfolio management, and it was a great skill set to have because they were trained from the local banks, and lenders are trained in a certain way to be, you follow the process, you don't diverge from the process very often, and you're relatively conservative. That's the bank's mindset. And that worked well, again, when we were evaluating and structuring a deal. They would get a little bit uncomfortable with the equity risk, but we were doing a lot of training on that. On the portfolio management side, it became a bit more of a challenge because they didn't necessarily have any operating experience with companies. And it's difficult to tell a guy who's been, in the SME lending department for 5 years, who joins your team, hey, now you're going to go and help this company structure a sales commission plan for their salespeople, or you're going to help them set up their accounting system, or we're going to try to give them some input and advice on how to do digital marketing. Whereas somebody who's more on the equity side, that's more their bread and butter, is really understanding some of those aspects and bringing those skills to bear to a portfolio company. And what we tried to do is we managed quite a few trainings within Growfin, and tried to, through those trainings and then through hands-on training, get the portfolio management team up to speed on some of these things. And as I mentioned, it's an 80-20 rule. 80% of your consulting or business engagement with your portfolio companies is around 20% of the topics. So if you can get your portfolio management team some core training on how to set up accounting and financial reporting system, how to do a marketing analysis, how to structure sales commissions, for example. That's going to cover a lot of the engagements, business development engagements you're going to have with your portfolio companies. But it was definitely a challenge because in a more developed market like United States, there's a very clear line between people who do lending and people who do equity investments. And when you try to combine the two, you need to find people who can kind of straddle both sides of the line, and it's hard to find.
Okay, so one last question about portfolio management. I mean, sometimes what you see is you may have your kind of investment officer who is person maybe 30 something, and then you can supplement the value added to the portfolio company by, on a case by case basis, bring in some sort of operating partner, like a retired executive with a lot of experience in that particular sector, and you maybe fund them by the company or with the technical assistance. So did you have any kind of, were you ever making use of sort of operating partners on a case by case basis, maybe to come in and bring in a kind of body of experience that a, more junior investment officer may not necessarily have, or more credibility?
Yeah, Grofin, yes. We had a very strong team based out of South Africa where the company was headquartered. And they would provide a lot of that assistance to the fund managers in the different countries. We also tried to bring in fund managers that had, that were older, obviously, more senior, that had a wide range of experiences that would be able to bring some of those broad skills to bear at the country level. But it was on the actual investment officer level, you're right. We're working with a lot of men and women who were in their, let's say, late 20s to late 30s, whether they were junior or senior. And it was important for us to supplement their skill set with folks who had more skills. I think the one comment the manager of Grofin had once when I joined, and we were discussing this, he said, and my background is primarily equity. He said, look, it's easier to teach an equity guy what debt management is all about than it is to teach a debt guy how to manage an equity portfolio. And I think it's true. It's and that's not a knock on the debt guys, but the debt side is more formalistic, more following the process, whereas the equity management side and portfolio management side is a bit more dynamic, and you need a more flexible and broad skill set. So I would be even more inclined, if looking at those types of structures or setups, management, operational setups again, to look for someone, preferably from the local market, if you can find them, who has a bit of a equity background and is a bit more dynamic on their skill set. Learning the debt process is not as time consuming. The other thing I'll mention that Grofin went through quite a long, I joined Grofin maybe 10 years after they'd been founded, something like that. And they had gone through a long process of understanding debt structures and putting in place a lending policy. And that was a lot of trial and error. And I think they got it pretty well refined by the time I joined. But I think that's an important thing if you're going to do these kinds of structures, is to set up a proper lending policy. But then, of course, again, with the caveat of structuring around equity risk, and then having that portfolio management piece in place. So
having an in-house policy for lending of the debt instrument as a framework, and then you would then use that as a building point to construct a deal structure. Would that be a fair summary?
Exactly. And being fairly consistent. In the equity world, you'll see all kinds of exotic structures because you can look at each deal differently, and you can be flexible around it. And on the debt side, again, we are more flexible than a bank would be, but we definitely were much more rigid in equity fund. We had to follow certain processes and procedures and a lot of that was trial and error. We tried more flexible things and found it didn't work. So we had to come back to being less flexible and using structures that we knew worked.
Okay, excellent. So let's move on to our last topic, which is returns and exits, the full private equity cycle. So maybe starting with returns. So did you have a target return for your debt products, and did it sort of did you have? I mean, for whatever equity you did do, was that a different return? What were the? I mean, I think it was a dollar fund. I mean, what were the returns, the targets, and what were the actuals?
Yeah. Again, it differed from market to market. So in Oman, where I was the fund manager, it was a very stable economic environment, a very low inflation, and we were targeting something like 9 or 10% return on our capital, whereas a senior lender in that market was targeting maybe 5%. In other markets where you had, if you have 15% inflation, you've got to target a real return of, let's say, 10%. So you're looking at an interest rate of 25%. And of course, you have to be careful in each market to make sure that's permissible. Some markets have caps on how much you can lend. So the interest rates would be variable based upon the market. But again, it was whatever interest rate we charged would be appropriate for the equity type risk we were taking. You can't take equity type risk and charge like a senior lender because
so would it be something like five points above the senior lender kind of return, something like that, as a rough benchmark?
Yeah, it's between 5 and 10. Yeah.
Between 5 and 10 over the senior lender, depending on the market. Okay.
Yeah.
Okay.
Yeah. And getting the money back, again, we would generally be the debt as a self-liquidating instrument. We would get paid back through our debt repayments. In some cases, we actually had the company got sold. And as I mentioned, we would have change of control provisions so we can demand repayment in a company sale. Sometimes the investment didn't work out and we had to go through a collection procedure. And we would utilize the courts if necessary and seize assets and liquidate them. Obviously, we tried to avoid that whenever possible. And I think that's a really important point that I should stress here. Because again, a lot of my team were debt guys. And even though we were taking equity risk, when a company didn't perform well, their knee-jerk reaction was, let's go seize collateral. And I remember one case where we had invested in a fish processing company. And it was a startup. And they were way behind schedule on developing the company and building the facility. And there were reasons for that, getting permits, getting electrical hookups, things like that. But they were past due on the loan. And at one point, Grofin had moved forward with collecting and basically seizing the assets of the building before the company had a chance to get started. And I joined the fund and I went down and met with the guy and he explained to me why they were late. And he showed me that they had just started production a month earlier and he asked for more time. He asked for 6 months delay. And I looked around and I said, I did some analysis and I called him up. I said, look, I'll give you 9 months delay, but then you can't miss a payment. And he was very thankful because he got the breathing room he needed to launch the business, get his working capital going because he had to establish his inventory and his receivables. And 9 months was enough time. And after that, he made every payment on time. And he actually won the Entrepreneur of the Year award in Oman, I believe in 2013. So on the one hand, we could have closed him down in 2011. But we looked at it and said, wait a minute, this is actually a real business that has opportunity, but let's look at it as an equity provider. An equity provider doesn't.
Yes, I was going to say, it seems the secret ingredient to make an operation work using debt instruments in such a market is to maybe use a debt instrument, but the investment officer should have an equity mindset, not a debt mindset. Would that be right to suggest?
I think that's, yeah, absolutely. Absolutely. That's a great way to put it, and that's the kind of team I would look for.
Okay, well, I think that's been a fascinating discussion. I have one question from my audience: is did Grofin ever finance startups in Africa?
Yes. We did quite a few startups in Africa. All kinds of different businesses. Agribusiness, schools was our biggest sector, actually, if I remember correctly. We'd done something like 25 schools across the entire portfolio, and they're actually very good clients. We did very well with that, but absolutely they were doing startups, and I believe they still are.
Okay, Jonathan, well, thank you very much for your time. It's been a great conversation exploring the differences between debt and equity in emerging markets investments. So thanks for your time, and see you again on the show. So from me, Gavin Ryan, it's goodbye. Thank you, Jonathan.
Thanks, Kevin. It was great to be here. Talk again soon.